In Atlanta's Fulton County, 1 out of every 5 single-family renters receives an eviction notice. This is not the natural byproduct of a localized economic recession, but rather the precise output of a Wall Street algorithm. Across the United States, invisible corporate buyers are quietly outbidding everyday families with all-cash offers, successfully transforming the American dream into a multi-billion-dollar, hyper-financialized asset class. When a neighborhood is consumed by institutional capital, a 30% rent hike is not a market accident. It is a strict corporate mandate, and it is the exact mathematical trigger quietly manufacturing the most severe street-level homelessness crisis in modern American history. The invisible neighbors with infinite cash. Between 2018 and 2024, an unprecedented influx of institutional capital completely rewrote the economic DNA of the American suburb. Following the blueprint established in the aftermath of the 2008 financial crisis, private equity firms and asset management conglomerates escalated their purchasing strategies to an industrial scale. Today, large-scale corporate landlords, entities that own 1,000 or more properties, control roughly 450,000 single-family homes nationwide. Industry lobbyists consistently attempt to neutralize public concern by arguing that this figure represents a statistically insignificant portion of the national housing stock, often citing that institutional investors own just a fraction of all available homes. However, that defense relies on a deliberate mathematical illusion. Corporate acquisitions are not spread evenly across the country in a manner that diffuses their impact. They are ruthlessly hyper-concentrated in vulnerable, high-growth Sunbelt markets. When zooming in on the granular, zip code-level data, the scale of this corporate saturation becomes staggering. Government Accountability Office data confirms that in targeted markets like Jacksonville, Florida, institutional investors have cornered a massive 22% of the entire single-family rental market. In cities like Atlanta, Charlotte, and Phoenix, the corporate acquisition blueprint follows the exact same aggressive trajectory, with investor purchases accounting for over 30% of all single-family residential sales in states like Georgia and Arizona during peak buying periods. The systemic danger lies in the vast asymmetry of resources. These institutional firms do not need traditional mortgages. They completely bypass standard bank appraisals, waive inspection contingencies, and deploy billions in liquid cash to purchase properties directly from owner-occupants. They operate at a velocity and scale that everyday citizens, relying on standard 30-year fixed-rate loans, simply cannot compete with. Furthermore, economic modeling demonstrates that for every single corporate purchase, the local supply of homes available to everyday owner-occupants is permanently reduced by 0.22 units. This dynamic occurs because institutional investors rarely sell their acquired properties back to individual families. Instead, these homes are permanently absorbed into massive, securitized portfolios, eventually traded only among other hedge funds or bundled into real estate investment trusts. By severing these properties from the traditional cycle of homeownership, Wall Street is not simply investing in real estate. These entities are mathematically manufacturing local scarcity, purposefully choking off the supply of entry-level housing to guarantee a captive market of perpetual renters. The 32% tipping point. This artificially engineered scarcity is immediately weaponized to maximize rental yields, which introduces the deadly mathematics of systemic displacement. Real estate executives routinely refuse to connect skyrocketing housing costs with a subsequent explosion of urban and suburban tent cities, treating the two phenomena as isolated issues. The economic data, however, renders that denial completely indefensible. An exhaustive multi-year study conducted by economists at the University of Pennsylvania and Boston University isolated a strict, unforgiving mathematical inflection point regarding housing affordability. The researchers discovered that when a community's residents are forced to spend more than 32% of their take-home pay on rent, a rapid, exponential spike in street-level homelessness immediately follows. This 32% threshold is not merely a suggestion of financial strain. It is the exact barrier where the basic arithmetic of human survival breaks down. Once rent consumes nearly a third of a household's income, families lose the ability to absorb routine financial shocks. A broken transmission, a minor medical emergency, or a few days of lost wages instantly cascade into missed rent payments. Knowing this, Corporate landlords utilize centralized algorithmic pricing software to aggressively push rental prices precisely to, and often past, this critical tipping point. Software platforms aggregate proprietary leasing data from thousands of property managers to artificially inflate prices across entire metropolitan areas, essentially functioning as a decentralized price-fixing cartel. By relying entirely on software algorithms, these firms successfully eliminate human empathy from the leasing equation. The algorithm is explicitly designed to probe the absolute ceiling of market tolerance. It calculates that holding a property vacant for a few extra weeks is statistically more profitable if the eventual tenant agrees to an inflated rate. This data-driven extraction strips up to 30% more income from working-class tenants than traditional mom-and-pop landlords who typically price homes based on local neighborhood relationships and stable occupancy. When a family's wage growth inevitably lags behind these algorithmically optimized rent inflations, they are pushed directly to the brink of the 32% collapse. The automated eviction engine. When a vulnerable family inevitably fails to absorb these mathematically engineered rent hikes, the corporate eviction machine engages with terrifying speed. In the past, traditional local landlords often provided a crucial safety net of human grace. A property owner who personally knows their tenant might negotiate a temporary payment plan during a family crisis, understanding that an eviction is costly and disruptive for everyone involved. Institutional investors, conversely, operate on ruthless, automated efficiency. Tenants are not viewed as members of community, but as temporary yield generators on a digital ledger. The moment a payment is missed, the software initiates the eviction protocol without human hesitation or intervention. Federal Reserve researchers tracking eviction records discovered a highly disturbing operational pattern. Large corporate landlords in major markets like Fulton County carry an eviction filing rate that routinely exceeds 20%. They file eviction notices faster, more frequently, and with zero localized friction compared to non-institutional owners. In many instances, the eviction filing itself has been weaponized as an ancillary revenue stream. Corporate landlords often charge exorbitant late fees, administrative penalties, and legal filing costs, transforming the sheer threat of homelessness into an additional profit center. This model functions as a highly efficient displacement factory, routinely churning through lower-income families to justify marking up the rent for the next occupant. The collateral damage of this automated engine extends far beyond the immediate loss of shelter. Every eviction adds a permanent, toxic scar to a renter's consumer record. Because the modern housing market is equally dominated by automated tenant screening software and eviction filing, even if the tenant ultimately pays their balance or settles out of court, acts as an algorithmic death sentence. A corporate eviction effectively blacklists families from the standard rental market entirely, instantly disqualifying them from securing future housing at standard market rates. Once blacklisted by the software, these displaced families are violently removed from the traditional housing ecosystem, leaving extended stay motels, passenger vehicles, or a nylon tent on the pavement as their only remaining statistical probabilities. The mathematical trajectory of tomorrow's tent cities. The most alarming aspect of this systemic displacement is that the data indicates the United States is not observing the peak of the crisis. The nation is merely establishing its baseline. Recent data released by the Department of Housing and Urban Development in their 2025 annual homelessness assessment report confirms that over 745,000 Americans are currently experiencing homelessness on any given night, representing the highest figures on record for unaccompanied individuals. The geographic distribution of this suffering perfectly maps onto the footprint of institutional housing acquisition. The areas most vulnerable to this specific brand of corporate unaffordability currently hold just 15% of the United States population, yet they account for an astounding 47% of all people experiencing homelessness. If corporate acquisition trajectories continue to target mid-size, high-growth markets unchecked, economic models predict an absolute catastrophe. Wall Street requires compounding, perpetual growth to satisfy private equity shareholders and deliver promised returns. This financial architecture demands steady, annualized rent increases of 5 to 7%, entirely divorced from the reality of local wage stagnation. Industry forecasts, including major projections by investment management firms, estimate that by 2030, institutional investors could scale their portfolios to control 40% of all single-family rental homes on the market, equating to roughly 7.6 million properties nationwide. If wages remain flat while corporate consolidation captures nearly half of the single-family rental supply, the math becomes inescapable. The nation will systematically breach the 32% affordability threshold in dozens of new suburban markets that have historically never experienced widespread displacement. The algorithms will continue to probe for maximum yield. The eviction factories will process the inevitable defaults, and the tenant screening software will blacklist millions of working-class families from the housing ecosystem. The data provides a chilling guarantee. Without aggressive, systemic legislative intervention designed to legally cap institutional ownership and restrict algorithmic price fixing, the sprawling tent cities currently lining the sidewalks of Los Angeles and Seattle will cease to be coastal anomalies. They will become the standard, inescapable geographic feature of every major American suburb.